Yeah, hi friends. A very good morning to all of you, and welcome you all to the hangout session on the foreign exchange market and its impact on asset classes in India. On behalf of Kotak Securities, I, Anindya Banerjee, will be your host. I'm with the organization for the last 4 odd years, and with a total experience of around 10 years in the financial markets. I had the good fortune of analyzing multiple asset classes, from commodity to equity to the forex market, and to a certain extent the debt and the interest rate markets as well. Over here, I'm responsible for helping individuals like you and corporates to make informed decisions in the foreign exchange market. This market, though, might appear very complex, but with the right assistance and the guidance, uh, can be quite profitable and an exciting market to explore. So, ladies and gentlemen, right now you might be thinking, why should I at all care about this market? Does it have anything for me? I invest in the equity and the debt market and the commodity market. So how does forex affect me? Can I at all trade this market in India? To address all your apprehensions on forex, friends, let me give you this phrase: if the economy is like a human body, currency or the foreign exchange is like a heart. Like a body needs a strong and a healthy heart to survive, so the economy and in fact the entire civilization needs a thriving forex market to sustain. Uh, Friends, money as we know it has been for ages, but it has transformed through history. It started off as a barter system. It moved on to being a commodity currency like gold, silver, and copper. Then it went on to become, as we know it, the paper currency like the rupee, the dollar, the euro, and the pound and the yen. But this paper currency system that started somewhere after the World War One had also an evolution. Till 1970, the paper currencies of the world were linked in some form or the other to the gold standard. Means a particular central bank in the world had to own a certain amount of gold and silver for their currency to have a proper value. But after the 1970, there was a major transition in the global forex market. Now the paper currencies which we use have no backing at all. It doesn't matter how much the Reserve Bank of India owns gold or at all for the rupee to have a value. So in today's world, the value of a currency is determined at two levels. Level one is what is the value of the rupee against the other currencies, which is determined by the market. Level two is what is the worth of the rupee against the a real currency like gold. So gold has become the universal currency of choice against which all paper currencies are measured. So the historical significance of gold as a money is all well known. Because of its metallurgical properties, that gold has attained that status. So it is in a way a signaling instrument that tells us what is the true worth of our rupees. Now, over the next hour or so, during the course of this presentation, I will answer the following uh, the following questions. First, what drives the uh, what drives the rupee, and what might be the trend going forward? Second, how can rupee affect your investments in the stock market and the debt market? And finally, how can we trade the rupee in India through the foreign exchange derivatives market, which is there on the exchanges? So now let me take you to the presentation. So as I said, that the three questions in front of us. One, what drives the rupee and what might be the trend? How can rupee affect your investments in India? And how can we trade the rupee in the exchange traded market? Let's start with the first question. In order to answer the question, we need to take a peek into the pages of history. As Mark Twain famously quoted, history does not repeat itself, but it does rhyme. We therefore should be aware of the past to understand the present and build a bridge to the future. Friends, currency valuation is like judging contestants in a beauty contest, where relative outlook matters most. FX market is unique in a way that only here that one has to speak and trade in relative terms. Whenever a rupee is bought or sold, the trade is not going through unless you specify what currency that you are going to do on the opposite leg. So we buy rupee and sell the dollar or sell the pound or any other hundreds of currencies in the world. This is not the case when you trade any other asset class, be it commodity, be it debt, be it the the equity markets. There, when you buy a particular bond or particular commodity or particular share, you just pay in rupees. That's fixed. But here, we always trade in a pair. So that is a very important thing to understand, that currency markets trade in a pair. So when we say, I believe the rupee is going to strengthen, I have to also specify against what. It could be strengthening against the dollar, but weakening against the euro. So that is a major shift in the mindset which has to happen when you're approaching or understanding the foreign exchange market. Now, the value of a currency is driven by three kinds of factors. One is economic, two is political, and three is external. All these three mix and match together to create the sentiment. And the sentiment can either be positive for rupee or be negative. The prevailing sentiment in turn drive the speculative positioning in the derivatives market for the rupee. So like say in 2013, say take the period between May and August of last year, we all know the sentiment towards India was extremely bad. There was something known as the policy paralysis, or some called it the policy coma. We had the central bank who was looking extremely lost as to how to address the rampant devaluation of the currency. And the effect was that negative sentiment made rupee far more weaker because the speculators kept on shorting the rupee because the speculators found selling the rupee was a profitable trade. So these three factors, political, economic, and external, affect sentiment, and they in turn uh, drive the speculative fervor in the market. Now, since independence, Indian rupee has been losing its value steadily. The chart in front of you is has the data between 1974 to all the way down to 2014 now. There is not enough data available since 1947. Otherwise, I would have loved to put the chart since independence. But to give you an idea of the same, in 1947, against the US dollar, the Indian rupee used to trade at 1:1 at par. And by now, it has lost 98% of its value against the dollar. That's a significant, say, depreciation. Bulk of the depreciation occurred post 1965 through three crisis periods. One was the first crisis of 1965 to 1970. The next one was 1980 to 2000. And the final one, which we have just lived through, 2011 to 2013. What preceded these three crisis periods were factors which were similar in nature. What were those? As I've outlined, see on the slide, for India. We had closed economy. Now, when economy is closed and not integrated with the world economy, inefficiencies arise. What were those inefficiencies? It was low productivity, high inflation that led to low growth, social strife, and that led to political uncertainty and a whole host of bad policy choices from the government as well as the central bank. And in between, we also had to fight the war against the China as well as against Pakistan twice. So all of them took a toll on the rupee, and rupee entered a vulnerable period. Now, as I said, currency valuation is a relative game. So during the period between 1978 to all the way 2000, if you compare where American economy stood, it was a stark contrast. They had an open economy. There was a IT revolution which was on. The services sector was growing. The financial sector was booming. Growth was high. Productivity was high. Inflation was low. There was political stability. The policies were excellent. So it was a complete contrast to where India was. And the result was bulk of the depreciation. That's 85% of the devaluation happened during those 20 to 24 years. And at the same time, as I said, the third factor, external events like the Asian financial crisis, the emerging market crisis, they also played a role. Like between 1990 to 2000, a number of global crises happened, be it geopolitical, be it economic. On the geopolitics, it was the Gulf War, which led to the oil price shock. On economics, the Asian financial crisis, the LATAM crisis, the Russian crisis, and the tech bubble burst. They all added to the woes of the rupee because dollar had become the global currency of choice. Now we move to the next slide, and over here we will see something change quite drastically. Focus on the period between 2002 and 2007, the green box on your left. Now, this year, for the first time in the history of the rupee, we saw a sustained and a long period of appreciation. Though it was gradual, but nevertheless, it was sustained appreciation that the rupee had not seen till date. What changed? What changed was we had an economic boom. So growth was high for the first time for 7 to 8 years. We had low inflation, high productivity, excellent policy choices, stable government, and at the same time, external factors, as I said, there was a global economic boom. Money was moving towards the emerging markets, and India being a part of that block, India also got wet in that shower. So that was the reason why we got this sustained appreciation in the rupee. Come 2008-9, we got the global financial crisis, which was an external event, and we got a very sharp devaluation because whenever there is a panic or a risk in the global market, the world money managers tend to shift towards the safe haven. The safe haven currencies are gold and the dollar. They flock to the gold market. They flock to the US Treasuries to seek this safety, and as a result of which we get the dollar, which moves up substantially against the emerging markets and other riskier investment markets in the world. 2009 again, once the global financial crisis abated, we got a sustained appreciation in the rupee. But since 2009-10, things started changing in India. There was again the policy paralysis, which we came to know. Bad policy choices were made. Growth started falling because investment was low. Productivity started falling. Inflation started to go up, and as a result of which we had an over dependence on the foreign investors to fund our foreign currency needs. The result was a debilitating depreciation, which we saw from the levels of 44 in 2011 to all the way down to 69 last year. Eurozone crisis also played a major role, because when we become too dependent on the foreign investors to fund our need of the foreign currency, the crisis like the Eurozone crisis, which played out in two chapters in 2010 and 2011, 11-12, has an impact on those flows. And the moment those flows dry up, we get a depreciation. Now, since 2013 September, there is a hope trade which is on. With a new government at the center and a new central banker, there is hope that India will be able to embark on a path of growth and low inflation, which will create a period of long and stable Indian rupee. Now we come to the next part. As I said on the slide where I showed you how the Indian rupee has behaved since the 1975, that three factors drive the value of the rupee. Now, in the economic factors, what are those economic factors which drive the rupee? When we analyze any currency, here it is the Indian rupee, you must understand the flows very well. You have to. It's like the cash flow statement of a corporate. What the inflows and the outflows of cash which happens from the corporate coffers. Similarly, for a country, the flows and the inflows and outflows of foreign currency is termed as the balance of payment. For corporate is cash flow, for us it is balance of payment. So if you understand the inflows and outflows well, you will be able to gauge which way the Indian rupee can move, say over a period of time, something between 6 to 9 months. Now the inflows, if we now focus on the other factors, the next important factor to watch out that would drive the value of the rupee over the longer term, over the medium to long term, is going to be the economic growth, which I harped upon a number of times as I talked about the history of the Indian rupee and the speculator and the sentiment in the market. Now, focusing on the flows, we have the inflow. What are the major sources of inflow? Exports. Now, these figures are as of last year. Exports was $471 billion, where imports, that's an outflow, we had $545 billion, leaving us a total net deficit of $74 billion. That was a hole. So we had more imports than exports. We had to bridge that. So we got the money from whom? Our friends in the West or abroad, the Indian workers who send remittances back to India. That was around $65 billion. Great. It bridged almost the entire gap. But then we had to make payments to the foreigners in lieu of their investments in India, like the dividend payments, like the interest payments, like the share of profits, like royalty, and etc. etc. Because as the foreigners increase their investments in India, the payments will rise, because it moves hand in hand. And last year, the total payment which we made was around $24 billion. Now, all of these left us a deficit of $33 billion. So this deficit is known as the current account deficit. Why current account? Because all these transactions happen with regularity year after year. So they are recurring in nature, so it's known as a current account. Now this deficit had to be breached. Otherwise, we had to face a substantial impact on the value of the rupee, because the Central Bank of India cannot print dollars. It can only print rupees. Now we had to approach the foreign investors or the NRIs to bridge that gap. Now $26 billion came as investments from the foreigners. Now when we talk about the foreign investment, there are two ways these foreigners are going to lend money to Indians. One is through equity investment. Two is through investment in debt or loans given in foreign currency. Now, out of the two, equity investment is preferred because it is much more sticky, stays on with us irrespective of the ups and downs of the economy. Uh, Over debt, which is much more fleeting. If there is a global crisis, debt investment will be the first one to move out, like the one we saw last year. A huge outflow happened from the debt market, which triggered the sharp depreciation in the rupee. But what we got last year, 26 billion came as FDI and FI investment in equity. The foreign currency loan was around $8 billion. The NRI deposit was huge. It was the $39 billion. Reason being, we had floated a scheme to, to encourage the NRIs to invest in the Indian banks. Now, this entire receipts is known as capital account balance because these receipts are capital in nature. Now, when we try to balance the current account and the capital account, what we get, the net balance is called the balance of payment. And that was, we were balanced because we got a total capital receipts of around $50 billion. And we had a current account deficit of around $33 billion. So we were comfortable. So that's the reason why, as we approached in the second half of the last financial year, rupee stabilized. Now, this is the historical progression of how capital account and current account has done. Now, focus on the box which I outlined, 2010 and 13. As our current account deficit increased substantially, it ballooned, our dependence on the foreign investors increased. And every episode of crisis, be it the emerging market crisis or the Eurozone crisis, triggered a sharp depreciation in the rupee. The Indian rupee is the black line. Previous to 2010 or 9, the current account deficit was under control, so rupee was stable. Now, the next concept which I would like to get your attention to is inflation. Because I talked about apart from the demand and supply factors, the next factor is growth and inflation, which drives the value of the rupee. Growth, we all know, it is, and how high growth can be sustained, that um, uh, a good set of policy choices has to be made. Investment climate has to improve. Investments need to happen. We need to utilize our natural resources, and etc. etc. But what is inflation? The reason I wanted to spend some time is what I realized is that there is a lot of misinformation which is spread about inflation, and there is a lack of understanding. In fact, not many years ago, I also used to be confused with the term inflation, because what I used to say, gather from various articles and the commentaries, is that inflation, price rise cause inflation. But then it occurred to me, price rise, increase or decrease, price is a signal. How can a signaling instrument cause something? It's like saying the temperature of my body cause my fever. It's actually the other way around. Fever causes the temperature to rise. Similarly, when I dig deeper, I realized inflation means to increase, but it's increase not in prices. It means increase in the supply of money. It's very easy to understand. If I increase the supply of anything, the value of that particular thing will decline. So when I increase the supply of money in the country, then what happens? The value of the currency goes down. So it goes through devaluation. So anything which is traded or represented in that currency, like apples to stock market to real estate, will become far more expensive. So that is inflation. Now, how can we increase the supply of money? It can be done in two forms. Either we print money or we increase the supply of credit, because credit or loans are nothing but we are borrowing from the future. So it is two ways we can increase supply of money. Now, out of the total stock of money supply at any point in time, credit will be the far biggest than it will be far say larger than the the amount of the cash currency which is there in the system. So now the next question comes: who has the right or got the power to create the money supply? Credit can be created by the banking system and the governments, and money supply, the cash, can be increased by the central banks by money printing. So banks, central bank, and the government has the authority to create inflation. So that is the concept of inflation and how it affects a currency like the rupee. As Milton Friedman, a famous economist, once said, inflation is always and everywhere a monetary phenomena, in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output. It's simple, it is easy to understand. Now, if you see the next slide, what we find is that this is the depiction of how the money supply in India behaved since 1975 and how the rupee behaved against gold. Because, as I said, gold is the universal barometer of currency value. It is because gold is not controlled by any central bank in the world. It is not owned by any government. So any central bank or government cannot print gold and increase the supply of gold. It can only come from the mines. So gold has become the barometer. In fact, that's the reason why some developed market central banks don't really like when gold prices increase in their currency. In fact, some of them even go to the length of saying gold is not money, but history is clear that gold is money. And what we see in this is up till say 1999, the money supply was increasing at a steady rate. So gold, the Indian rupee was getting devalued against the gold. The green line was increasing, but something changed in 2000 and 2001. There was a rapid growth of money supply in India, and that led to a sharp devaluation in the Indian rupee against gold. It's absolutely a no-brainer when we compare the two and find out the cause why Indian rupee devalued against gold. Means when the gold prices rise in the Indian rupee, the other way of saying that is Indian rupee is getting devalued. So that is the important concept of how inflation affects the Indian rupee. Now, this is a depiction, a pictorial depiction of what I have told till now is importance of economic growth and inflation. Now, if you see, the blue line is the real GDP growth. The red line is the consumer inflation. And the green line is the depiction of the Indian rupee. What it means is that how many rupees can I how many dollars I can buy with 100 rupees. So if it is going lower, it means I can get only less and less dollars. So the rupee is getting devalued. Now what we see is from 75 and before till say 2002, inflation used to be high and growth used to be low. So Indian rupee had a steady dose of depreciation. Since 2002, as I outlined in the previous slides, inflation was low, growth was high, and we had a change, a very stable environment in the rupee, and the rupee appreciated. Again, since 2009-10, things changed, and back we are in the depreciation mode. So for now, for the rupee to move from year-on-year depreciation to year-on-year appreciation, it needs an environment where inflation will be low and growth will be high. There is a hope that the existing government, along with the central bank, will ensure that. We hope the same because the financial markets are watching, and if we can deliver on that, then we will get a period of stable Indian rupee against many currencies in the world, and especially against gold. If not, then the market is there to punish the rupee. Now we come to the final factor, which is known as the speculators and sentiment. Speculators are very essential for any market to mature, because in financial markets, or for that matter, any market for asset classes, there are three kinds of players who are needed to for that market to work quite seamlessly. One is the speculator, the other one is the arbitrager, and finally is the hedger who comes into the market. Speculators takes the risk from the hedger, the commercials in the market. So the, over the last 7-8 years, Indian rupee has become a very popular currency among the global hedge funds and the global players. And as a result of which, what has happened is outside India, a derivatives market on the Indian rupee has thrived and become quite large. It's known as the NDF market. Uh, it's a non-delivery based market. So people can't take delivery or give delivery of the Indian rupee. So it's more of the cash settled, the dollar settled market which is there. The large foreign banks, they create this market. They are like the mini exchanges, and that has become so large that it is now equal in size to the domestic market for the Indian rupee. So as a result of which, what has happened is that the value of the Indian rupee has started to be dictated by what is happening in the NDF market, or the speculative market of the rupee. The speculative trend is very important to understand what could be the impact on the Indian rupee over the short to medium term. That means, say between, uh, say intraday to say between 6 to 9 months. So that is a very important factor to keep in mind. Now, in order to map the sentiment, what I have created is a sentiment matrix. Now, in the sentiment matrix, what we find is that through the sentiment, the market is trying to assess what could be the impact on demand and supply of the foreign currency in future. Now, for example, let's take the example. Let's take an event, a geopolitical say event. Then a news flashes about a major uh, social uprising in the Middle East. Now, what will happen? Oil prices will rise immediately. Now, if the oil prices rise, what the speculators will think is that higher oil prices mean India has to import more in dollar terms, means India has to pay more for the oil imports, because we import roughly, say, around 75 to 80% of our energy needs. As a result of which, what will happen? The current account the deficit will rise, the corporate profitability will shrink, and equities, as a result of which equities fall, the bond prices fall, and as thinking all of this, US dollar is bought and the rupee is sold. This is the entire flowchart of decision making which goes on in a split of a second. It's as if it's like a reflex. Next is a news which on a government policy. Government raises the FDI cap on some major sectors. What will be the impact? People will think, the speculators will think that foreign investment will rise, as a result of which equities, they might do well because the companies who will be in that sector will do well. So the right thing to do is to sell the dollar and buy the rupee. Again, a reflexive trade. Next one is a major sell-off event. Let's say overnight, some news hits about a default from a large European bank, and global markets are down, all in the red. Asian markets in the morning are bleeding heavily. Now, what kind of a decision making goes through the mind of the speculator? The foreign currency loans might not happen. The investment flows which keep happening to India won't happen. So India, who is dependent on the foreign investors to fund the currency needs, won't get those funds. So equities will fall, the bonds will fall. The right thing to do is to buy the dollar and sell the rupee. So this is how any news which hits the market, you will be able to understand how it is relevant for the rupee, and how significant is that impact. So significance and importance are the two things which you can gauge about any news through this information flowchart. Now, this shows how the Indian rupee has behaved against the major asset markets. what we find on the first chart is that this is the INR per USD. What I've done, I've inverted the quote, that how much of dollars how much of rupees one will get for $1. I've inverted the chart to understand that what has happened is that the correlation between the Indian rupee and the domestic stock market has actually diminished since 2011 and 12. But the correlation between the Indian rupee and the emerging market currencies like the Brazilian real has increased a lot. The reason being is that we have become far more dependent, as I showed, on the foreign investors for to meet our current account deficits. We are importing more than what we export. And that is taking a toll on the Indian rupee far more. So at times when the equity market is selling off, in equity terms, it might not fall by a significant percentage, but on the impact on the rupee is far more, and the recovery in the rupee subsequently when this stability is getting achieved is not that much. So as a result, what has happened, the correlation between the Indian rupee and the stock market has broken down. Rather, going forward, what you need to track is the emerging market basket, the Brazilian real, the Turkish lira, the South African rand, to understand which way the external events can affect the rupee. Now, say taking all those factors, what I outlined in front of you. Now let's try to form a view on the Indian rupee in the months ahead. What I've done is I've listed a list of the positive factors and negative factors. In the positive factors, stable government at the center, hope that the policy mix will be right from the government as well as the central bank, expectation the growth will pick up, the jobs will be created, etc., etc. All these factors are what is acting on the positive side in the rupee. On the negative side, we have still the import dependency is still high. In fact, it is being contemplated that once the growth picks up, we can see the imports rise because the domestic industry might not be immediately be able to suffice that increase in demand from the domestic economy. So we might end up importing more. That might hurt the currency. Then there is the geopolitical risk. In fact, it is said that almost like more than a tenth of the world is at war now. So and then we have the complacency which has come in the financial markets, and there is the RBI which is committed to buy the US dollars. So all these things, when we compare, we arrive at a consensus estimate for the Indian rupee against the US dollar between say 58 half to 61 half and 62. The Indian rupee is going to stay in a range. It's not going to see a large trend. The reason being is that on one hand, we have the international investors who are committed towards India and who want to invest in India. So any sharp devaluation in the Indian rupee beyond 61, say 61 half or 62, will be bought. But at the same time, RBI is quite committed to build up its reserves. So it is willing to buy the dollars below 60. So anything between 58 and 59 will be quite conveniently bought by the RBI. So over the next 9 to 12 months, unless some major geopolitical event happens or an economic event happens, we might stay in this broad range. Beyond 12 months, the trend of the rupee will depend on the factors, as I said, whether we are able to transition towards an environment of low inflation and high growth. Now we come to the part B of the presentation. Is that how does the rupee impact our investments in the stocks and bonds? So the Indian rupee has a profound impact, especially on companies depending on whether exporters or importers. At the same time, Indian rupee can also have an impact on your investments in the debt market as well. Like we saw last year when RBI had to increase rate, thinking that hiking rates will stem the devaluation of the rupee, and the result was overnight interest rates went up by almost 350 basis points. So all these things we will discuss in this leg of the presentation. Now, if we see the sectors, information technology, it is export oriented. A weak rupee is always beneficial. Then is pharmaceuticals, again an export oriented sector. Weak rupee is beneficial. Oil companies. Now PSU oil companies, they have a subsidy regime to adhere to. So for them, a strong rupee is needed to bring down the subsidy bill. Say similarly for the power sector, the metals and mining, what we see is for the power sector, strong rupee is important because they import a lot of raw materials, coal and others from the international market, for which they have to make dollar payments. And they also have a lot of unhedged dollar loans. So strong rupee decreases their foreign currency burden. Metals and mining, weak rupee is again beneficial because the price which they get, like let's say a copper manufacturer, his copper price is dependent on the international markets. So it's the copper price in dollars converted into Indian rupees. And similarly for fertilizer, strong rupee is good because the fertilizer sector imports a lot of the raw materials as well as finished product from the international market. Capital goods is also impacted by the rupee because they have a lot of unhedged foreign currency loans. Tourism, on the other hand, wants a weak rupee because of the more uh, tourist inflows which can happen into India. So this is a sort of structure of how Indian rupee can affect various sectors. Now we also have the real estate, auto sector, telecom. So we find a whole host of sectors in the equity markets which are getting impacted by whether the rupee is weak or strong. So it's very important to understand this impact and to gauge which way a strengthening rupee or a weakening rupee will affect your investment in the stock market. Now this is a pictorial depiction of what I just outlined. What we find is that the rupee Indian rupee depreciated, IT and pharma companies did quite well against the broader market. The effect of a weak rupee, same thing on the PSU oil companies, they underperformed as the rupee depreciated, and since the rupee has bottomed out, we have seen a sharp outperformance in companies like BPCL against the Nifty. Now this is the impact of the rupee on the 10-year bond. Now the impact of rupees, if you see historically, there is not a very strong correlation. What we see is that at times the correlation has come, like in 2008-9, when the oil prices jumped upwards and RBI had to hike rates to control the inflation. The Indian rupee also depreciated in tandem. So bond interest rates went up, Indian rupee depreciated. Same thing happened last year. So what it means is that using interest rates to control the rupee backfires. Now we come to the final part of the presentation. Is after all this, you might be curious as to how I can trade in this asset class. In fact, this asset class in the world trades a 5.5 trillion dollars a day. That means it trades almost 2.5 times the Indian economy every day if we add up all the currencies. So it's the world's largest asset class where every participant is taking an exposure, be it the central bank, be it the government, be it the organizations, the exporters, importers, uh, individuals, the hedge funds, the investment community. Everybody is taking an exposure in this asset class. So it's an asset now with the change in the regulation in 2008. Individual investors can participate in this in the rupee exchange market through the NSE, UCX, and MCX, SX, and BSE as well. Now, at this point in time, we have four rupee contracts. We have the euro, we have the British pound, we have the Japanese yen, we have the US, we have the US dollar. Uh, then so what we have at this point in time is futures contract on, say, on the euro INR, the Japanese yen, the US dollar, and the British pound against the Indian rupee, and they can be traded through brokers like us, and it's a market which is between 9 to 5. There is a talk of extending the trading hours beyond 5. So if it happens, it will increase the participation and the volume in the market. But what is important in trading a currency market is that it's, at the end of the day, it requires immense amount of discipline, because you are dealing with derivatives. It is not a cash market, so one has to be disciplined. So with proper guidance and with self discipline, one can definitely make it a profitable venture. Now, these are the contract specs of the various contracts which are available for trading. We have the dollar rupee, which is $1,000 per lot, the euro INR 1,000 euro, and for every tick movement. Now, one tick is it's quarter of a paisa is one tick, and the tick value is 2.5 rupees per lot, and the margin is quite low compared to what you pay in the equity and the commodity markets. It's between 3 and 6%. So the leverage is high in these markets. That's why there has to be immense focus on discipline, because high leverage can give you high rewards, can also penalize you quite immensely if somebody is not disciplined. And with this, we come to the end of the presentation. Uh, so we hope that you have been able to enjoy this entire journey, over which we have covered the importance of the foreign exchange market in India, and its impact on the various asset classes, and also how you can participate in this market. In future, we will be actually doing a lot more hangout sessions on the foreign exchange market, over where we will deal specifically into how to trade in this market, which will because we have to combine both technical and fundamental factors to trade in this market. That will be covered in the subsequent presentation. In the meantime, if you have any queries which have say not been answered, or which which have cropped up, say right now, as you have participated in the hangout session, you can actually write to us. The email ID is on the screen in front of you. And thank you all for attending the hangout session. Have a good day.